Good to see you again today. Okay. I appreciate all the support. And trust me, we're working really hard to begin distribution. Okay. All right. We've been looking at earnings per share. Of course, we've looked at basic, we've looked at diluted. Okay. And then we've been talking about profit. Now, I want you to understand something that, financial statements sometimes can have, of course, you're talking about the same thing, but depending on whoever is preparing it, you can have some nomenclatures used to describe the same thing. Because I remember one of my review meetings where one of the executives will keep asking, Ebitda. Okay? Of course, Ebitda means earnings before interest, tax, depreciation, and amortization. Okay? But that's what we're discussing today. We're looking at Ebitda. So Ebitda here represents earnings before interest, tax, depreciation, and amortization. Now, understand that whenever you hear earnings, we're still talking about what? Profit. So when you hear earnings, you mean profit. Okay? Now, but one thing is that there are some users of financial accounting information, or let's say some management executives, senior, of course, the C levels, that would always want to know the profit made without taking into considerations expenditure items that does not involve movement of cash. Of course, depreciation that we charge as an expense does not involve movement of cash. It's a gradual write-off of, the capital expenditure incurred, okay, at a particular period of time over several period of time. So if you bought a vehicle for, like, let's say 10 million naira, okay, you write it off gradually, maybe over 5 years, depending on the policy of the organization. Anyway, some users of financial information or users of accounting information always want to know the profit before depreciation, but they will tell you that operationally depreciation is not really part of the expenditures that are actually taken into consideration to gradually write off a cost that has been incurred and which is also capital in nature. So today, I want us to quickly understand how to, arrive at what? Ebitda. So to make it simple, what we're saying earnings before interest, tax, depreciation, and what? Amortization. So what we're saying is that when you have a profit, before you charge your expenses, of course that is gross profit. Now the expenses you're charging will exclude interest on maybe loan or debenture interest. It will exclude tax. It will exclude depreciation and what? Amortization. That is what we call earnings before interest, tax, depreciation, and what we call Ebitda. So what I'm saying is this. So what we're saying is, let's say you have your gross profit to be an X amount of money. Because normally what we do is we say less total expenses. But in this case, we say less what? Operational expenses. Now, in these operational expenses, we are excluding interest and what? Depreciation. So it means that when you take out your operational expenses from your gross profit, you're having an X amount. So this, okay, is your earnings before interest, tax, depreciation, and what? Amortization. So what do? You now less your what? Your depreciation and what? Amortization. So when you take that out, this is an X amount that you now call what? Earnings before interest and what? Tax. Okay? Now, at this level, you can now less your what? Your interest. When you take out your interest, you have an X amount. This you call earnings before what? Tax. Now, at this level, you can introduce your what? Your tax provisions. When you take that out, you have an X amount, which you now call earnings after tax. So, if we don't want to use earnings, we can use profit. So here, we can simply call it profit, right? Before interest, tax, depreciation, and what? Amortization. Here, we can call it profit before interest and tax. Here, we can call it profit before tax. Here, we can call it profit afterwards, tax. Okay, so what I've been able to explain to you here is to help you understand Ebitda, because you might be in an environment as an accountant where the culture or the practice in that environment is the use of what? Earnings rather than what? Profit. And then there might be attention on what? On Ebitda, EBIT, and what? EBT and EAT. So you should understand what they are saying without getting what? Confused. Then also understand that sometimes some other guys use different, what they call it, different what? Terms to say the same thing. So your Ebitda can also be referred to as what? Core earnings. Some guys use core earnings. Some guys use pro forma earnings. And then some guys use operating profit. So it simply means that if they are not using Ebitda, they might be using core earnings. They are not using core, they are using pro forma earnings. They are not using pro forma earnings, they might be using what? Operating profit. So these all mean the same thing. But remember that whichever way you tailor it, make sure you are working in accordance with what? The standards and principles in practice wherever you are what? Reporting. So this is what I want to share with you today. Okay? So that you understand that, okay, sometimes instead of using profit, earnings can be used. And then some environments pay attention on what? Ebitda. And if they don't want to use Ebitda, they can use core earnings, or they can use pro forma earnings, or they can use operating what? Profit or operating earning. Okay? So you should understand that they are saying this, and this is the simple approach towards arriving at your what? At your Ebitda, to your EBIT, and then to your EBT, and then to your what? EAT. Of course, at this level, you now compute your what? Your earnings per share. Of course, I know you know how to do that already. I already talked twice on earnings per share. Of course, we have basic earnings per share, diluted earnings per what? Share. We have classes on this, you should take them. So when you get your earnings after tax, you can go ahead to prepare your what? To calculate or show your what? Basic earnings per share and what? Diluted earnings per what? Share. Okay? So this is a summary of, what I want to share with you today regarding what? Ebitda. If you have questions, you can reach me on the numbers displayed. Let's reply with the right answers. This question, okay? So we have this question here. The following trial are written from the books of Jordan Mega PLC for the year ended at 2017. So we have sales, cost of sales, admin, selling, non-current, interest due, and all that. Then we have debtors, cash at bank, bank loan, vendors. So we say the business on 1st September 2018 issued a fully paid 10 million ordinary shares at 150 kobo per share. This is reflected in the records. There's an issue of share there. Accrued expense amounted to 4 million. The business depreciate non-current asset at 10% per annum. Business provides for tax at 32%. You're required to prepare income statement for the year ended at 2017 showing the earnings per share. And then we have a statement of financial position. So this is like a build up on something that we've done earlier. And then we're going to test another aspect. Of course, now remember I told you that you can have ordinary shares within a period that does not qualify for basic. So in that case, you have to use diluted to potentially recognize them in computing the earnings per share. So let's quickly look at this question here. Okay, so it's Tilda. Mega PLC. So we have income statement for the year ended 31st December 2017. So we're already used to all this at this level. Shouldn't be an issue. So we have note 1 here. This will be your turn over. Right? So what's your note 1? What do I see there? I see that sales there is 250,000. So we have sales. This is 250. Okay, so the next one there is cost of sales. Cost, we say cost of sales, that's note 2. So let's call that note 2. So we have cost of sales. What do we have there? 130 million, that's 130,000. So we have 130,000. So when you take this out, 0, 0, 0, 0. 5 minus 3 is 2. 1, 2 minus 1 is 1. So we have 1, 2. This is your gross profit. So usually we would have introduced total expense, but because we're looking at getting our Ebitda, we're going to introduce operating expense. So that will be on note 3. So note 3 will be operating expense. Of course, that will be expenses excluding interest and depreciation and tax. Okay. So what do we have there? Admin expense. So we have admin. What's admin there? 25 million. So what's the next one? Selling expense. What do we have there? 30 million. That's 30,000 there. Okay. And then that will be 55,000. There's an accrued expense in the additional information, if you remember. So what do we have there? 4 million. So accrued expense will increase the expense. That's 4. So they have 0, 0, 0. This will be 9, 5. So operating expense is 59 million. Take that out. What do you have? 0, 0, 0. 10 minus 9 is 1. This will be 11. That will be 61 million. So this is the operating profit or core profit or core profit or Ebitda. So we can call this our what? Ebitda, which means earnings before interest, tax, depreciation and what? And amortization. So let's go. The next one we have our what? Depreciation. Let's call that note 4. So what's our depreciation? Okay, that what? What they say 10% per annum is what the business depreciates its non-current. What are non-current? 140 million. So depreciation will be what? 10 over 100 times 140,000. So what do you have? 0, 0, 0, 0. What do you have there? 14,000. So this is your depreciation. If you look at the depreciation here now, take this out. What do you have? 0, 0, 0. This will be 11. 11 minus 4 here will be 7. Meaning 5. 5 minus 1 here will be what? 4. So we have 47 million. So this will not be your what? Earnings before interest and what? Tax. Okay? So now let's introduce our interest. So we have interest. Let's call that to what? 5. Okay? Interest due. So what's there? Interest due according to us 10 million. We have 10 million. So that means here is 10 million. So we take that out. This is 0, 0, 0. 7 minus 0 is 7. Oh, this 37. So this will not be a what? Earnings before what? Tax. Okay? So now we introduce our what? Tax. So what's the tax provision now? Of course, that's at what? 32%. So we have tax at what? 32%. So what do you have? So that will be 32 divided by 100. Okay, times 37 million. $11,840. So we have 11,840. So we take this out. What do you have? $25,160. We have $25,160. So this will not be your what? Earnings after tax or profit after tax. Okay? So now let's go. We now have our what? Basic earnings per share, diluted earnings per share. So how do we calculate that? How do we calculate that? So what do we have here? So our what? Basic earnings per share will be what? Earnings after tax over what? Unit of what? Ordinary what? Shares, right? Qualifying for what? Dividend. So let's say unit of ordinary share qualifying for what? Dividend. So here we have 25,160 over. What's the ordinary shares here? According to the question, we have what? 200,000 shares. So that will be 200,000 plus. Okay. What do you have now? The share amortization, we have 10 million there. Okay, 10 million shares. Issued when? September. That will be September, October, November. That's 4 months. Plus 4 divided by 12, right? Times, okay, what? 10 million, which is 10,000 here. So what do we have? 200,000 plus, let's clear this bracket now. Let's clear this bracket. We have 4 divided by what? 12. Okay? Times 10,000. Just 10 million there. I can see 33. So this is 3333. Okay? So that will be plus 200 million. So that means, let's do it like this. That will be 25,160 over 200,000 plus 3333. So that will be 25,160 over 23,333. Right? So what do we now have? You can now say 25,160 divided by 23,333. So what do we have here? 0.12. So basic earnings per share will be what? 12 kobo. Now remember I told you that in a particular year, all I've done here is that already there is 200 million shares in the book. The company issued 10 million shares, okay? And then it was issued in September. So September, October, November, December, that's 4 months. So when you prorate, this is what qualifies for dividend. So this is what you have for what? Basic earnings per share. And I told you in the class for diluted earnings per share, you can go and take that sometimes you have shares within the period that does not qualify. So for basic, you take that, but for diluted, you will look at the potential, because eventually, of course, all the shares issued will qualify for this. So here, we're going to say diluted earnings per share. Now that will not recognize all of them. That will not be what? Of course, you now have 25,160 all over all the shares, which will be what? 200 million shares plus the 10 million shares what issued. Of course, that will be 25,160 all over what? What do you have there? Clear. 200,000 plus 10,000. So what do you have? 210,000. So this will be equal to what now? 25160 divided by 210,000. So what do you have here now? I have, okay, I have 11.98 kobo. So this will be 11.98 what? Kobo. Because that's your what? Basic earnings per share and diluted earnings what? Per share. I already taught a class on basic earnings per share and diluted earnings per share. So you should take that class. So let's proceed straight to our statement of financial position here. So we have statement of what? Financial what? Position as at what? December 2017. Okay, we have our notes. So here is our assets. So non-current. So that will be note, what's that now? Let's call that note 6. So we have our note 6 here. So we have non-current. What do we have? 140. So with less depreciation, which is 14,000, right? So what do you have? So we have 140,000 minus 14,000. 126. This is 126,000. We have 126,000. So the next one we have current asset, note 7. So we have note 7. So what are the current assets according to the question? Debtors, 45. So what's the next one? We have bank, 180. Remember, our bank now will be 180,000 plus the new share. The new issue, there's 10 million. 10 million times 150 kobo. That's 10 million times 1. Okay. 150. So that's what? Excuse me. So we have 10,000 times 1.5. What do we have there? That will be 15,000. So plus 15,000 here, or which is 15 million anyway. Try to understand why I'm saying 15,000. You call the 3 zeros up there. Okay. So we have 180,000 plus 15,000. 195. So we have 195,000. Is there another thing there? Is there another thing? Is there another thing there? Let's check. There's no other thing there. Okay, so here we're going to have 0, 0, 0, 0. This is 10. 4. This will be 2. Right? Yeah. That's 240,000. So we have 240,000. You add this, you have 0, 0, 0, 6, 6, 3, 6, 6,000. So this is represented by what? Liabilities. So we have short-term liabilities. Let's call that note 8. So we have note 8. What's the thing you have there? Vendors. What are vendor? Vendor there is 20,000. We have our accrued expense here. Where is it? 4,000. So this will be what? 24,000. Oh, there's tax. Let's not forget our tax. Tax here, 11,840. So we add up what you have? 0, 4, 8. This will be 5. 35,840. That's 35,840. So what long-term liabilities here? Note 9. Let's call that note 9. What long-term liability? We have bank loan. So what's our bank loan? 90,000 according to the question. So what else there? Any other thing there? What's our bank loan there? 90,000. So we have 90,000. So what's the next one there? Our reserve, of course, that will be 10. So no 10, that's our profits after tax. What do you have there? 25,160. So we have 25,160. So what's the next item there? That will be share capital. Okay, so we can just say note 11. Note 11. So existing, what do we have? 200 million according to the question. Right? 200 million. Then there's a new one issued. That's what? 10 million. Of course, this will be what? What now? New shares. That will be 10 million. That will be 210,000. Remember, there's a premium on this, and that premium should go to your reserve. So we have 210 million. Then this reserve here will increase. Okay, that will be 25,165. Let's show it separately. Part is 25,160 premium. 5,000. That's the 50 cover on the what? Shares. So that will be 5 million. 5,000 here. So what do you now have? 06103 3160. So this will be what? 3160. So let's add up. What do we have here? 35,840 plus 90,000 plus 3160 plus 210000 366,000. So we have 366. So this is your what? Total liabilities. This is your what? Total assets. So what we've done here is to, of course, show us another approach that is likely to help us understand how to derive Ebitda. Okay, Ebitda means earnings before interest, tax, and depreciation. And then in it, we also tested, combination of our basic earnings per share and diluted earnings per what? Share. Okay, so if you have questions, you can reach me on the numbers displayed. I'm there to reply with the right answers. And don't forget, you can support us by paying to the account numbers displayed or sponsor copies of my textbook for free distribution. That's how you can support us to keep going. Of course, we're going to keep going. Thank you. Support us. Of course, we'll keep giving you topics after topics, week in, week out.